Let's go to our next headline. Why a decade of reckoning is coming to the bond market. I want to read this quote from Ben Harris. When Moody's downgrades your credit rating, that's a red flag. If we go from a 100% chance of getting paid on your treasury to a 99.8% chance of getting paid, that is a massive shift. This is no longer a risk-free asset. This is a risky asset in terms of default risk, and that makes our whole fiscal outlook that much worse. Harris says if interest rates climb toward 5% on the 10-year or even 6% or higher, investors may buy more treasuries instead of other assets. As he puts it, the real threat is that this could spark some sort of fiscal crisis. Your thoughts on this?
Yeah, I think the downgrade is priced in. I think treasuries are trading with a little bit of credit risk. Really, like the US is never going to default, like even under Trump, like it's not going to default. You will just get paid back in depreciated currency, right? So it's not like you're going to have a treasury bond and the government says, sorry, we're not going to pay you, and it just goes to zero. That's not what a default is going to look like. A default is going to look like the scenario I always describe where they peg the yield curve and they print a bunch of money and we have a bunch of inflation and it basically becomes worthless over time. That's how the default happens. And it's funny because there's CDS on sovereign credit. There's CDS on credit default swaps on the United States. And it's a weird instrument to trade because there's really no scenario where those things are ever going to pay out. Those will never pay out.